Joining us from Cincinnati, Ohio this morning to share his thoughts, Nick Sargen, Chief Investment Officer at Fort Washington Investment Advisors, joining us. And Nick, what do you think of this warning coming from Fitch and Moody's?
Well, Susan, I think it all comes down to what was your expectation. I think what the rating agencies were saying is they wanted the grand compromise. And what did that mean? They were hoping that the European governments could take strong enough measures, say to promise not to run large budget deficits, that then actually the European Central Bank would say, okay, we're comfortable now, and we'll go in and buy Italian and Spanish government debt and keep those yields under control. So clearly what happened is the Europeans did do something on the fiscal front, but it wasn't enough to make the European Central Bank comfortable to say, we'll backstop you no matter what. The key for me is the European Central Bank says we're the lender of last resort. We're going to provide liquidity to the banks, but that doesn't obligate us to buy sovereign debt.
Okay, so I guess the question is, though, does the European summit stave off these downgrades? Isn't that the big concern right now, Nick? Is that, I guess the biggest one would be Germany and France losing their coveted AAA rating. What does that mean for the rescue fund?
Yes, I think that the my expectation right now is they kind of telegraphing. It reminds me, Susan, of in August when the S&P was watching the U.S. deliberations over the debt ceiling and said, if you don't come up with a grand compromise, we'll downgrade you. Now, of course, they did that in a week. I think this one will take a little bit longer, but I think you have to be prepared that there will be across-the-board downgrades probably by the first quarter. Right now, though, I think that news is largely priced into the market, so I wouldn't expect that if they finally do it, that it has a huge ripple effect.
How concerned are you about this European story and whether or not we still have unraveling still to come?
Yeah, Susan, it's the most difficult issue that I focus on. If I could just focus on the United States, the story here is that we're muddling along. The data have actually come in better than expected, and companies are doing okay. So you'd be somewhat optimistic if it was just the U.S. But there are two things that you have to worry about in Europe. One, whatever the rating agencies do, we know that Europe is on the cusp of a recession right now as we're speaking, and that's going to be a drag. The European economy is as big as the U.S. in size, so that will have some global impact. The second thing, in the bigger here, is I can even live with Europe in recession. What you don't want to see is this financial contagion, because then that would mean that U.S. banks, are back into the situation that they have to curtail credit. So that's the bigger risk for me. But right now, I'm positioning for a muddle-along scenario.
A muddle-along scenario. So what do you think, that Europe's going to come out of this intact? Are you satisfied with the European Summit and the solutions they basically suggested?
I think that I'm less fearful of an absolute breakdown of the Eurozone. So I think that they'll patch whatever they have to do to keep the system intact. So that's the one thing. But on the other hand, as I say, they're living with a world of austerity, and that's not going to be good either for Europe, and it's going to be a headwind for the United States and Asia.
Okay, quickly, Nick, what are you doing with your investments going into year's end and in the start of next year?
Yes. Right now, Susan, within the world of equities, there's been one strategy that's done pretty well, and I think it will continue to do well in the United States, the strategy of investing in higher dividend-paying stocks,
okay,
fairly high-quality companies. I think that would be the focus. We've been shorting the euro.
All right, Nick, shorting the euro. It's a pleasure speaking to you.